Welcome to my channel. I'm Scott, and in this video I am going to walk you through the process of valuing Micron stock by analyzing their financial statements and dissecting their financial ratios so we can determine if it's a buy or a sell. Micron designs, develops, and manufactures memory and storage products. It provides foundational capability for artificial intelligence and 5G across data centers and consumer devices. Some of the industries that use its products are healthcare, automotive, and communications. It has almost 50,000 patents and 12 manufacturing sites. It has a footprint in several cities in the US, also in Canada, China, India, Malaysia, Taiwan, and several more countries. Its consumer products are marketed under the brands Crucial and Ballistix. Recently, they announced they'll be investing up to $150 billion over the next decade to expand its fabrication capabilities. Similar to Intel, Micron manufactures its own chips and wafers. Nvidia, AMD, and Qualcomm are fabless, meaning they outsource chip manufacturing. Taiwan Semiconductor is the largest foundry in the world. Foundry means it manufactures chips for other companies. Micron is headquartered in Boise, Idaho, and was founded in 1978. It trades on the Nasdaq, Deutsche Börse, Mexican Bolsa, Xetra, Swiss, Borsa Italiana, Vienna, Lima, Kazakhstan, Sao Paulo, and London Stock Exchange. Let's get started with the model. This is a large cap company, 92 billion market cap. They're trading at $82 a share, and they have 1.1 billion shares outstanding. Let's look at their financials. The way you value a company is you estimate the free cash flows into the future, and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. They had their most free cash flow in the trailing 12 months close to $4 billion. Free cash flow is the cash that's remaining after paying all your expenses and investing back into your company. Net income is the profit or loss on the income statement. It's revenue minus expenses. That also peaked in the trailing 12 months at $7.4 billion. Revenue is the sales for the company, and that grew from $23 billion to $30 billion. This is the company's income statement. The top line is the revenue, the sales. Below that is the cost of revenue. These are the expenses directly related to generating the revenue. Cost to manufacture their products is part of cost of revenue. Revenue minus cost of revenue gives you your gross profit, and that peaked in the trailing 12 months at $12.3 billion. Below that is their operating expenses. R&D is a big operating expense for this company. Gross profit minus operating expenses gives you your operating income, and that was also highest in the trailing 12 months at $8.5 billion. They received $37 million of interest on their investments, and they paid $180 million of interest on their debt. Below that is other income and expenses. These are all the gains or losses not part of the company's core operations. They had a negative $501 million. This is probably an asset impairment. Below that is their pre-tax income, then their taxes, then their earnings from their investments in other companies. Earnings from equity interest doesn't get taxed. That's why it's below the tax number. And the bottom line of the income statement is their net income, which was the highest ever in the trailing 12 months at $7.4 billion. This is the company's income statement from their quarterly report. This shows us the 3 months ending December 3rd, 2020, and the 3 months ending December 2nd, 2021. Their revenue jumped from $5.8 billion to $7.7 billion. Their revenue in DRAM went from $4.1 billion to $5.6 billion. Their NAND revenue went from $1.6 billion to $1.9 billion. Dynamic random access memory is short-term memory for your devices. NAND is permanent storage for mobile devices. NAND is not an acronym. It stands for not and. Their revenue also grew in every category: CNBU, MBU, SBU, and EBU. CNBU is their biggest by far, $3.4 billion, up from $2.5 billion. That stands for Compute and Networking Business Unit. An example of this are products that are used in the cloud. MBU stands for Mobile Business Unit. This is memory and storage products for mobile phones. SBU is Storage Business Unit. EBU stands for Embedded Business Unit. Their cost of goods sold is $4.1 billion, so their gross profit went from $1.7 billion to $3.6 billion. It doubled. They wrote gross margin. Gross margin is a percentage. This should say gross profit. Their gross margin is 46%. That's gross profit over revenue. Of the 68 semiconductor companies, the median is 48%, average is 44%. So they're right there in the mix. They spend a lot of money in research and development because they're trying to improve their current products and come up with new ones. That was $700 million. Last year was $647 million. Selling, general, and administrative was $259 million. So their operating income went up a ton from $866 million to $2.6 billion. They paid $45 million of interest on their debt, which is a little less than last year. And the bottom line of the income statement is their net income, which almost tripled from $800 million to $2.3 billion. Their net margins are 30%. That's net profit over revenue. The median in the industry is 10%. The average is negative 2%. So they're doing much better in that category. This was from one of their presentations. Their revenue doubled from 2015 to 2021, and it grows every single year. Same thing with cash flow generation, it grows every year. Their asset base went up 4x from 11 billion to 42 billion because they spend a lot of money in building factories. That's an asset that gets carried on the balance sheet and depreciated over its useful life. They also buy expensive machinery and equipment for the factories. That's also carried on the balance sheet and depreciated over its useful life. This is the company's statement of cash flows. The top line is operating cash flow. That's how much cash the company generates from its operational business. So they generate tons of cash flow, over 14 billion in the trailing 12 months. And they spend a lot in CapEx because they do manufacturing, which is expensive. They spent 10.5 billion in the trailing 12 months. These are investments in property, plant, and equipment. Operating cash flow minus CapEx give you your free cash flow. They just started paying a dividend with their free cash flows. September 2021 was their first dividend payment, and they paid their second dividend payment last month in December. They do buy back a lot of stock. They bought back 2.7 billion in 2019, 250 million, 1.3 billion, and 200 million. Every time a company buys back common stock, it decreases the shares outstanding, making your shares more valuable. They paid down more debt in 2021 and the trailing 12 months than they issued. But in 2019 and 2020, they issued more debt than they paid down. This is their operating cash flow section from their statement of cash flows. This is directly from their quarterly report. This shows us the 3 months ending December 3rd, 2020 and the 3 months ending December 2nd, 2021. The way you calculate operating cash flow, you start with your net income. Then you have to add the non-cash items on the income statement, 1.7 billion of depreciation, 118 million of stock-based compensation. You also have to adjust for changes in working capital. They bought 344 million of inventory. That's a cash outflow. But when they use that inventory, then they'll move it onto the income statement and it'll be a cash inflow in that accounting period. They reported an accounting profit of 2.3 billion, but actually generated 4 billion of cash flow. Last year, it was an accounting profit of 800 million, and they generated 2 billion of cash flow. The reason their cash flow is so much higher than their net income is mainly due to depreciation. Depreciation is a non-cash item that brings down your net income, but it doesn't affect cash flow. This is the investing and financing sections from the statement of cash flows. The top line of the investing section is investments in property, plant, and equipment, also known as CapEx. That was 3.3 billion. They sold one of their manufacturing facilities in Utah and received 893 million of cash. In their investing section, they had a cash outflow of 2.5 billion. In their financing section, they paid down 2 billion of debt. They bought back 259 million of common stock. They paid 112 million of dividends. It looks like they bought 100 million of common stock from their employees. They issued 2 billion of debt, so they had a cash outflow of $500 million. This is the equity section on their 11/30 balance sheet. They raised $10 billion from selling their business. They profited $41 billion from running their business, and they bought back $5 billion of common stock. When a company buys back common stock, it decreases their equity balance. That's why it's negative. Let's look at their capital structure. 46 billion of equity, 7.5 billion of debt. They're 86% equity, 14% debt. And they could pay off all the debt with the cash on their balance sheet and still have 2 billion of cash left over. I gave them the middle whack on Finbox, 7.2%, and that's a discount rate we're going to apply to the future cash flows. We estimated 3 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 3, that's 85 billion. We discounted those numbers back to today using the weighted average cost of capital. We get a value of the company of $78 billion. We divide that by 1.1 billion shares. And we get a calculated stock price of $70. They're trading at $82, so they're trading at a 17% premium. It's a sell according to the model. Their revenue is projected to grow 10.6%, so I grew their revenue 10.6% for the next few years. That's how I got their future revenue estimates. To get their future free cash flows, I need to see what percent of their revenue they convert to free cash flow. I summed up these 4 free cash flow numbers and I divided by these 4 revenue numbers. That comes out to 10%, so I multiplied their future revenue estimates by 10%. That's how I got their future free cash flows. Simply, Wall Street values the company at $72. They're saying it's 18% overvalued. 24 analysts priced this stock and the average price target is 112. The low is 58, the high is 165. This is where the stock has been trading the last 2 years. So from the bottom to the top, it pretty much doubled. And the market has been coming down the past few weeks. So lots of stocks have been losing money. It is possible the bear market may continue further. That's why when I buy a stock, I hold it long term. Because if you buy good companies like this, you should make money over time. They just started paying a dividend, a 10-cent quarterly dividend. The dividend yield is 0.5%, which is 6% of their net income, 12% of their free cash flow. So they can easily afford the dividend and possibly raise it. Their industry pays a 1.2% dividend, and analysts are forecasting the company to decrease its dividend to 0.4%. Their beta is 1.15, so the stock moves a little more than the market. It's only gone up 3% in the past 52 weeks, while the S&P is up 17%. The 52-week low is 66, the high is 98. And the stock is trading between its 50-day and 200-day moving average. This is a really popular stock. Nearly 20 million shares are traded each day. All the shares outstanding are on float. 80% are held by institutions, and only 2% of the shares are shorted. Their employee count has been going up little by little each year. They currently employ 43,000 people. If you invested $10,000 into this company 10 years ago, you'd have $107,000 today. That's a 27% annual return. In the past year, there's only been insider selling, no buying. These are all the people that sold, the date, how many shares, and the price they sold at. 80% of the shares are held by institutions, 20% by the general public. Vanguard owns 8% of the company, 90 million shares valued at $7.6 billion. BlackRock is close to 8%, then Capital Research, State Street, and PrimeCap. Let's look at their financial ratios. They have amazing price multiples, a PE of 12.5. That's stock price over earnings per share. For a company that's been growing at their pace, a PE of 12.5 is amazing. Price to sales of 3.1 and price to book of 2.0. Here's a list of their non-current assets: 1.8 billion of marketable investments, 35 billion of PP&E. They have 1.2 billion of goodwill. Goodwill is a premium you pay when you acquire another company. And 1.2 billion of other non-current assets. They have a really good ROIC of 16%. They can cover their interest payments 48 times. A high ROE of 16%. The market median is 7%. The average is 2%. Their current ratio is 3.1, so they can cover their current liabilities with their current assets more than 3 times. And their quick ratio is 2.4. Let's look at their current assets. 8.7 billion of cash, 900 million of short-term investments, 5 billion of receivables. This is how much money other companies owe Micron. 4.8 billion of inventory and $500 million of other. Let's look at their current liabilities. 5.5 billion of accounts payable. This is how much money Micron owes other companies. 118 million of debt and 900 million of other. They generated nearly 4 billion of free cash flow in the trailing 12 months, and they have nearly 14 billion of working capital. Working capital is current assets minus current liabilities. And they pay out less than $500 million of dividend payments, so the company is really well funded. It doesn't look like they're going to need any debt or equity financing to get through the next 12 months. The best way to look at ratios is to compare them to companies in the same industry. There are 68 companies in the same industry as Micron, and here's the top 20. And they're doing better in every single category, except their dividend is lower than average. They spend a lot of money in CapEx, nearly $11 billion. Their free cash flow is more than double the average. They're the 8th largest company in terms of market cap at $92 billion. They were over $100 billion last week, but the stock has come down. They have a much better price to book, price to earnings, price to free cash flow, and price to sales than the average company. They bring in lots of revenue, almost $30 billion, average is $6 billion. They're growing at a great rate, 18%, double the average in the industry. And they have a high ROA and ROE. So to summarize, I have them trading at a 17% premium. But if you look at the financial ratios, the stock seems really undervalued. The DCF model is just one tool. There's a lot of other things, like trying to figure out the future demand for the company's products. There's a big bottleneck in the semiconductor industry. There's so much demand that these companies cannot fulfill all that demand. That alone can be a great reason to buy this company, or any semiconductor company. But for a long-term hold, I think it's great. For a swing trade or short-term trade, it's really anyone's guess. I rank their free cash flows 9 out of 10, their revenue 8 out of 10, and their ratios 9 out of 10. So let me know what you think. Give this video a like, subscribe, or comment below. Also, if you'd like to get a custom valuation or just support the channel, you can become a member by clicking on the link in the description below. Thanks for watching.